Welcome back to the deep dive. This is our structured shortcut to being, well, truly well informed. Today, we are taking a really granular look at the financials of a company where the clock is always ticking. Virgin Galactic Holdings, Inc., ticker symbol SPCE, and this is hot off the press, following their Q3 2025 earnings release. Now, when you look at a high-profile pre-commercial space venture like this, the headlines, uh, they always seem to scream one of two things. Either they're soaring or they're completely grounded. So our mission for you, the learner, is to just ignore that noise. We're going to cut right through the press release fanfare, which, by the way, shouted beat, to really understand the underlying drivers. We're talking performance, financial health, and what management is actually planning. And we're going to do this using a structured five-part framework. It's the same kind of framework management uses internally, so we can extract every critical nugget of insight. This is how you figure out if a company is truly funding the future or if it's just, well, managing a slow, expensive shutdown.
That's really the critical distinction, isn't it? For a company like Virgin Galactic, you have to immediately adjust your analytical lens. This is not some mature manufacturing firm. It's a complex, capital-intensive development stage venture that is in just a relentless race against time. So the key financial focus here, it's not generating quarterly profit. I mean, that's a 2027 problem. It is burn management. It's all about the effective deployment of their current cash reserves to hit these very fixed technological milestones. We need to see if the company's extending their cash runway enough to actually reach that Q4 2026 commercial flight deadline without, being forced into some kind of emergency high-cost capital raise. So our analysis today, it's not just about the official data. It's about integrating that data with what the market expects and, of course, the required operational timeline. This is where we look for the cracks in the narrative.
All right, let's jump right into the financial cockpit. Now for slide 1, the at-a-glance scorecard. So we'll start with the initial scoreboard. How did SPCE measure up against the expectations set by Wall Street analysts? And, on the surface, the numbers look like a resounding win. Let's start with revenue. The company successfully surpassed the consensus estimates. They reported total revenue of $365,000.
Which, let's be honest, is a negligible amount in the grand scheme of a multi-billion-dollar valuation.
It is, but it still comfortably beat the verified analyst estimate range, which had anticipated revenue somewhere between, $315,000 and $339,000?
Right. And you pointed out it's just vital context to remember where this revenue comes from. It's sourced entirely from access fees related to future astronauts. So these are prepayments, down payments, deposits.
Deferred revenue, basically.
Exactly. It's cash inflow, which is good, but it's not cash generated from operational commercial flights.
Yeah.
It shows demand confidence, I guess, but definitely not operational profitability.
Right. But the real market excitement, the thing that moved the needle, that came from the earnings per share figure. The diluted EPS, which measures the loss per share, was reported as a loss of $1.09.
And analysts were expecting a much, much deeper loss. They were forecasting a range between $1.48 and $1.51 per share.
That is a massive difference, a saving of nearly 40 cents per share. That's what created that positive headline, that the company beat the street.
Oh, absolutely. That 40-cent reduction is significant, and it's the primary reason the stock probably reacted positively. But, and this is a big but, if we stop here, we fall into the trap. We're only comparing SPCE to market expectations. To understand the underlying operational health, we have to do an internal comparison. Q3 2025 versus Q3 2024. And this is where the story gets, deeply complex.
Okay, let's pull back the curtain on that year-over-year comparison, because the financial summary, it really does reveal a puzzle. Total revenue actually declined. We went from $402,000 in Q3 of 24 down to $365,000 in Q3 of 25.
That's a measurable 9.2% drop.
Right.
So, okay, revenue fell.
Yeah.
Logically, you'd think the net loss should have widened or maybe stayed flat. But instead, the net loss improved significantly. It shrank from a staggering $74.4 million loss last year to a $64.417 million loss this year. That is a solid 13.6% improvement on the total bottom line.
A $10 million saving. That's a huge accomplishment for management.
It is.
But hold on, the numbers get even more distorted when we look at the per-share data. The diluted EPS didn't just improve by 13.6%, it improved dramatically. It went from a loss of $2.66 to a loss of $1.09.
Which is a headline improvement of 59%.
59%. A 59% improvement in EPS when the actual operational loss only improved by 13.6%. That discrepancy is just massive.
It is. And here's the final piece of that puzzle you mentioned, the denominator. The weighted average diluted shares exploded from about 28 million to over 59 million.
That's a staggering 211.8% increase year over year.
And you've just isolated the core paradox of this entire report. How do we rationalize a scenario where revenue shrinks, the total net loss improves by a respectable amount, yet the loss per share improves 4 times faster than the total loss?
It has to be an accounting artifact.
That's the definition of an accounting artifact, and it's absolutely essential that you understand why it happened.
Okay, so let's unpack this. We need to deconstruct the beat and really separate the genuine operational improvement from, well, the financial engineering.
Let's start with the genuine operational win, because there is one. The 13.6% improvement in net loss. As you observed, this didn't come from sales. Revenue was down.
Right, down 9.2%.
This improvement came entirely from cost control and financial discipline. Management successfully implemented a really sharp reduction in total GAAP operating expenses. They cut them by $15.6 million, or 18.8%.
So they cut costs effectively enough to absorb the revenue dip and still come out with a $10 million smaller net loss.
Exactly. That signals good stewardship. That's a real win.
Okay, so that part, the 13.6% improvement, that's tangible. That shows management is serious about reducing the burn rate. They trimmed the operational fat. Now, let's tackle the much larger and far more flattering 59% EPS improvement.
Right. This is where we have to introduce the concept of the dilution artifact. To understand why a smaller loss became a much, much smaller loss per share, we have to look at the basic math of EPS.
Net loss, the numerator, divided by weighted average shares, the denominator.
Exactly. We already established the numerator, the net loss, improved by a real 13.6%. But the denominator, the share count, exploded by 211.8% year over year. Think back to our pizza analogy. The total loss, the actual size of the pizza, shrank by 13.6%. But to finance their survival, they cut that slightly smaller pizza into over 3 times as many slices.
So if you were an investor a year ago, your slice of the company, and therefore your portion of the loss, has shrunk dramatically. Not because the company suddenly became 4 times more efficient, but because your ownership percentage has been diluted by all these new shares they sold to fund the operation.
Precisely. The headline figure of 59% improvement is a result of spreading a slightly smaller loss over a vastly larger pool of shares. The majority of that improvement is paid for by shrinking the existing shareholders' equity position. This is the crucial point for the learner.
The cost of funding the journey to Q4 2026 is paid for through this ongoing massive dilution.
That's a takeaway.
And just to briefly address a technicality, we sometimes see this with companies showing a net loss, the anti-dilutive calculation. You mentioned for a company with the net loss, converting notes is often anti-dilutive, so it's excluded from the diluted share count. Why is that distinction important here?
It's important because it reinforces that the dilution we are seeing, this 211% jump, is real dilution. It's primarily driven by the active issuance of new shares through at-the-market offerings to raise cash. It's not some hypothetical dilution from convertible securities.
So it's not a what if, it's a what is.
Exactly. If the company were profitable, the rules would change, and they would have to include those convertible shares. But since SPCE is operating at a loss, converting those senior notes into equity would mean adding a large number of shares to the denominator without changing the net loss numerator, which would actually reduce the net loss per share. And that's counterintuitive to the conservative nature of the diluted EPS metric.
So that technicality doesn't change the fact that the actual shares outstanding are exploding, and that's what's flattering the EPS loss number.
Precisely. So
the bottom line from slide 1 is crystal clear. The beat was real, but its magnitude was artificially inflated by financial necessity. The 59% EPS improvement is the accounting noise. The 13.6% net loss reduction is the signal of operational discipline. Moving to slide 2. The engine of profitability. Okay, that was a fantastic deep dive into the scorecard. Now, let's leave the accounting mechanics behind for a minute and focus on the engine. For a pre-commercial company like Virgin Galactic, the engine of profitability is, well, it's not about maximizing income, it's about controlled, efficient cash outflows. In other words, burn management.
And the ability of management to control that cash burn is the single most important operational metric, period. Every dollar they save extends the cash runway and buys them invaluable time to hit those 2026 milestones. And in that regard, Q3 showed clear success. If we analyze the core business burn using the GAAP operating loss, we saw that number shrink by a substantial 18.8%.
Dropping from $81.7 million last year to $66.2 million this quarter.
Yes, that operational loss figure is pure proof of cost-cutting efficiency.
And it's one thing to say they cut costs, but it's another to see exactly where. Management clearly wielded the axe with some precision here. They didn't just make broad, shallow cuts. They really focused on specific, controllable expense categories.
That's right. And the most aggressive cut, and I think the most interesting one, came in research and development, or R&D expenses. They fell by a massive 37.5%, dropping from almost $24 million to $15 million.
Which immediately raises a red flag, right? We have to assess that because R&D is the lifeblood of any company building entirely new technology.
It is. The other key cut was in selling, general, and administrative expenses, SG&A. That fell by 17.7%, from $34 million down to $28 million.
Okay, that one's less controversial.
Right. It just shows they're tightening up overhead, marketing, corporate expenses.
Okay, let's unpack this and add some critical skepticism. A 17.7% cut in SG&A is, universally positive. Less money on corporate affairs is good. But a 37.5% reduction in R&D for a development stage company targeting a fixed Q4 2026 launch date, that smells like mortgaging the future. How does a company focused on building entirely new Delta-class spaceships cut R&D that aggressively without derailing the deadline?
That is the essential challenge you have to place on management's narrative. That reduction in R&D is only a positive signal if they are cutting non-critical spending, not core development spending. The argument management would make is probably twofold. First, they might have successfully finished certain expensive design or prototyping phases for the Delta class. That means the spending naturally shifts from R&D, which is proving the concept, to capital expenditure, which is building the asset.
So when a program moves into the fixed tooling and manufacturing phase, those costs move to the CapEx side of the balance sheet?
Exactly. And that allows the R&D bucket to shrink dramatically. Second, the cut might reflect the strategic decision to pause or slow down parallel development tracks. Maybe new technologies that were nice to have, but not essential for the Q4 2026 service launch.
So given the cash runway pressure, they are optimizing their immediate spending only on the Delta factory and the flight assets.
It's a necessary risk, but it is a risk. If any unexpected technological hurdle arises between now and the Q3 2026 flight tests, they have severely limited their resources to pivot quickly.
So we have to treat that R&D cut as a major double-edged sword. It's excellent for short-term burn management, but it eliminates the buffer for future technological surprises. It means they are executing a highly fragile, fixed timeline plan.
Exactly right. And this leads us to management's preferred view of performance, which uses their non-GAAP metrics. They claim it better reflects the core operational cash flow.
Okay, so let's quickly remind the learner of the distinction. GAAP is the official, externally audited standard. Non-GAAP, or adjusted figures, are management's way of saying, if we ignore all the non-cash stuff, here's how much better we look.
And the primary non-cash item that inflates their GAAP loss is stock-based compensation, the options and shares they grant to employees. When management adjusts for these, they arrive at their adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization, plus their specific exclusions.
And their adjusted EBITDA confirms the overall trend.
It does. It improved by 10.9%, resulting in a loss of $52.8 million compared to $59.3 million last year. This confirms that the operational cash needed for salaries, fixed costs, and necessary engineering work is shrinking. That is a structural improvement.
Okay, confirmation achieved. But the true, unforgiving measure of survival for this company, that's free cash flow. FCF. This is the ultimate operational ticking clock.
FCF is defined as net cash used in operating activities minus capital expenditures. It's everything. It encompasses not only the loss from operations, but also the cash required for those massive capital investments needed to build the Delta fleet and the manufacturing facility.
It's the total cash consumed by the entire enterprise during the quarter.
Yes. The performance was an improvement, but still a monumental burn. FCF for Q3 2025 was a burn of $107.8 million.
And that figure is an 8.6% improvement over the $118 million they burned in the prior year quarter. So that $108 million quarterly burn rate, that is the most important number the learner needs to internalize from this entire report. It is the company's fuel consumption rate. We know now that operationally, they saved about $10 million compared to last year, which gives them a slight extension on the runway.
And that number, that $108 million, it sets the pace for the company's sprint. If they can maintain this disciplined burn or maybe even lower it slightly in Q4 as they're forecasting,
they are buying themselves just enough time to reach that fixed timeline. It shows the successful execution of a cash preservation mandate.
And that is precisely the pivot point. We've established how much fuel they burn. Now we have to determine how much fuel they have left, which takes us directly to the balance sheet.
Now for slide 4, financial strength and shareholder rewards. We've locked down the burn rate, that critical $108 million per quarter. Now let's shift the discussion to financial strength, the balance sheet, and the all-important cash runway. This is about the company's resilience and really how long they can survive at their current rate of consumption.
So the balance sheet as of September 30, 2025, it shows the cash cushion. Virgin Galactic reported a position of $424 million in cash, cash equivalents, and marketable securities.
$424 million. That is the entire safety net they've built up, primarily through previous share offerings.
That's everything.
So let's immediately connect the dots. $424 in the bank, and a projected forward quarterly burn rate of about $100 million. And this estimate is reinforced by the Q3 Burn and Management's own Q4 guidance, which projects a burn between $90 and $100 million.
The math here is, well, it's unforgiving. $424 million divided by approximately $100 million per quarter provides roughly 4 quarters of liquidity.
4 quarters.
That funds the company at the current burn rate until approximately the 3rd or 4th quarter of 2026. This date is not flexible. It is the wall they hit, and we have to compare it directly to their promised commercial launch date.
So if they run at this controlled rate, they survive exactly until the moment their first commercial flight is supposed to take off. That margin of safety is, well, it's razor thin.
It is the definition of a high-wire act. And before we assess the timeline comparison, we have to understand the structure of their financial leverage. We can use the debt-to-equity ratio for that, comparing total liabilities to total stockholders' equity.
Okay.
The company carries $627.6 million in total liabilities versus $225.9 million in total stockholders' equity. That gives you a debt-to-equity ratio of 2.78.
Which is high leverage for a non-revenue company, but typical for this stage of development.
It is. But we need to look inside the liabilities.
And the most fascinating component of that liability structure, the one that just guarantees future headaches, is the massive $421.8 million represented by convertible senior notes.
That is the single most important detail on the liability side of the balance sheet. These are not just standard bonds, they are hybrid instruments. They start life as debt, meaning the company owes the principal back, but they give the holder the option, or sometimes require conversion into equity, into shares of stock under specific conditions.
And why does Virgin Galactic use them?
Because they pay lower interest rates than traditional debt. Investors are betting on the long-term stock appreciation. But the trade-off is this, that $421 million is a guaranteed source of massive future dilution.
Ah.
When the notes mature, or if the stock price hits a certain trigger, the holders convert, and suddenly over $400 million worth of debt turns into millions of new shares.
So the company is effectively delaying the cost of survival. Instead of having to sell shares now to pay for everything, they borrow the cash, and the inevitable dilution, the repayment mechanism, is just deferred into the future.
Precisely.
And this brings us to the section dedicated to shareholder rewards, which, as we discussed for SPCE, the rewards are negative. It's about consuming rather than returning capital. This is the cost of that convertible debt structure and the operational burn.
Dilution is the recurring theme. It's the mechanism by which current shareholders directly finance the bridge to profitability. Your ownership stake shrinks as new shares are continuously issued to keep the lights on and the Delta facility running.
And we have tangible evidence of this process happening actively in Q3. They generated $23 million in gross proceeds.
by issuing 7.4 million new shares of common stock through their at-the-market offerings.
$23 million in necessary cash raised at the direct cost of existing shareholders' ownership percentage.
And here is the essential synthesis point, linking this all back to slide 1. This constant necessary capital raising, the 23 million this quarter, hundreds of millions in previous quarters, is the mechanical reason the weighted average share count exploded by 211.8% year over year.
So the EPS beat was just a mathematical side effect of the fact that the company has nearly tripled its share count to survive.
That's it.
Okay, so to summarize the financial strength section, the runway is tight, only 4 quarters. The operational team is executing excellent cost control to preserve that runway. But the financial structure itself, dominated by those convertible notes, mandates that future dilution is not just a possibility, but a certainty. It's needed to pay off or service that massive liability as they get closer to commercialization.
We can confidently say that the company has enough cash to reach the finish line, but only if they are entirely successful in reaching the finish line on time. There is zero financial margin for error.
Now for slide 5, the road ahead management's outlook and key takeaways. Okay, we've established the financial boundaries. A 4-quarter runway ending approximately Q4 2026. Now let's transition to management's forward-looking statements. The question for the learner is, do the dates management committed to fit inside that financial box?
Well, management's financial outlook reinforced our calculations. They reconfirmed their Q4 2025 free cash flow guidance, projecting a burn in the range of $90 to $100 million.
So that locks in $100 million as the sustained quarterly burn rate we have to use for all future projections.
Yes. And now for the fixed timeline, the operational finish line. Management was steadfast in reiterating their key program milestones for the Delta program.
The crucial flight test program
Is set to commence in Q3 2026.
the very first commercial spaceflight.
Remains on track for Q4 2026.
And the private astronaut flights, the core revenue source.
Are scheduled to follow just 6 to 8 weeks after that first commercial flight.
And from a sales perspective, they are expecting to open the spigot for the first tranche of sales for the Delta-class flights in Q1 2026.
And this is the moment of maximum tension in the investment thesis. The cash runs out just as the first commercial revenue is supposed to arrive. And the CEO, Michael Glazer, provided the necessary detail that synthesizes this entire timeline. He stated they expect that most of our current customers will take their space journey during 2027.
That quote is everything. It confirms that Q4 2026 is the symbolic start, but the serious, sustained, necessary cash inflow won't arrive until 2027. This confirms the financial gap.
It does.
So let's delve into some critical scenario analysis now. What if the disciplined financial management from Q3 falters slightly? What if the burn rate increases by just 10% to, say, $110 million per quarter due to supply chain cost overruns or unexpected manufacturing complexity?
If the burn rate rises to $110 million, the $424 million runway shrinks immediately from 4 quarters to about 3.85 quarters. That effectively pulls the funding deadline from Q4 2026 back into Q3 2026.
So the money runs out just as the flight test program is beginning.
Which would create a crisis point. They would be forced into an emergency capital raise under immense pressure, which historically leads to even more punitive dilution for existing shareholders.
Okay, now let's consider the operational risk. What if the highly complex, first-of-its-kind Delta flight test program slips by just 6 months? I mean, space programs are notoriously prone to delay.
Right. So if the first commercial flight moves from Q4 2026 to Q2 2027, the company is suddenly facing 2 full quarters of a $100 million burn, with zero cash coming in from flights.
That is the crunch point. They have to find $200 million between Q4 2026 and Q2 2027 to bridge that operational gap. And since the cash runway is fully consumed by Q4 2026, in the best-case scenario, any delay means they must immediately raise significant capital.
Likely via more at-the-market share offerings or the conversion of those senior notes. The financial consequence of even a minor operational delay is guaranteed high-magnitude dilution.
So this entire analysis really boils down to 3 core takeaways, which should guide the learner's understanding of this report.
Takeaway 1. The beat was a story of discipline, not growth. We have to emphasize the operational achievement. The company is in survival mode, and management is executing effectively. The 18.8% reduction in total operating expenses, including that aggressive R&D cut, is the core positive signal. They're conserving capital.
Right. And the necessary counterpoint, takeaway 2. The headline, EPS beat, was a dilution-fueled artifact. You can't forget the numbers behind the narrative. The 59% improvement in diluted EPS is a flattering accounting figure, entirely predicated on that 211.8% increase in the share count over the last year.
The true operational measure, the reduction in the total net loss, was only 13.6%.
The learner must be able to spot this distinction immediately.
Absolutely. And finally, the overarching investment narrative, takeaway 3. The investment thesis is a race against time. The tight synchronization between the cash runway ending Q4 2026 and the commercialization timeline starting Q4 2026 and ramping in 2027 leaves no room for error, none.
The Q3 beat was fantastic for management credibility, but it did not fundamentally solve the fact that a capital bridge is required to get from the end of the runway to sustainable high-volume revenue in 2027.
The company showed great discipline, but the math confirms the structure of the venture. They are operating as a financially sound but structurally fragile development stage entity.
The Q3 report bought them time, proving they are capable stewards of capital.
But the core reality remains. To reach the 2027 goal of high-volume revenue, significant future dilution is a mandatory priced-in element of the journey.
And that structured framework, moving from the headline beat to operational discipline, analyzing the tight cash runway, and then comparing it against the committed high-risk timeline, is why we do these deep dives. It moves you past the celebratory press release and gives you the tools to understand the fundamental trade-offs being made by management. And that leads us to a final provocative thought for you, the learner, to consider. We identified $421.8 million in convertible senior notes, which represent a guaranteed future dilution event. Existing shareholders who have already weathered a 211.8% increase in share count are essentially paying the entire cost for the company to achieve commercial readiness.
The question is an existential one for the investor. What value does the existing shareholder receive for bearing this massive, necessary, and ongoing dilution risk? You're funding the Delta program, but every new share sold or converted reduces your ultimate return. What does the stock price need to do in 2027 and 2028 to make up for the fact that your ownership slice keeps shrinking right up until the point the company finally becomes reliably profitable? It's the ultimate trade-off between current ownership sacrifice and future potential reward. A high price for a potentially astronomical prize. Thank you for joining us for this deep dive into Virgin Galactic's Q3 2025 earnings. We hope this structured framework provides you with clarity and insight. Always a pleasure to analyze the data with you.
This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. The information contained herein is not a recommendation or solicitation to buy, sell, or hold any securities.
All investment decisions should be made based on your own research and in consultation with a qualified financial professional.
While efforts have been made to ensure the accuracy of the information, no guarantee is provided.
This report was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data obtained via real-time web searches.
Although the AI is designed to adhere to strict data sourcing and verification protocols, errors or omissions may still occur.
All information, including financial data and calculations, should be independently verified by the user before making any decisions.
Like and subscribe to StockAnalytics.ai. YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we are building out, and also get priority requests for company deep dives.